Now, the final thing on the funds flow, how to read the funds flow statement is very important because this is where we learn things. We have seen the procedures, process involved in constructing funds flow statement. Now, after that, what we can learn, that's more important. Here, constructing a funds flow statement is not a big thing, but what you have learned it, how we can read it. So, like that, here I have noted out. Here, three companies are there: X, Y, Z. Okay, these companies are there. We have funds flow. I have condensed it. A funds flow consisting of long-term sources, long-term uses, short-term sources, short-term uses. This is thing, na? We already done. Now I have bifurcated into different categories. So I have summed up how funds is moving, how the funds where has gone like that. So it is between long-term to use, short-term to long-term. I we have to find out. So in this case, X, Y, Z. In this case, you got to see first see this company X. So long-term sources 1,000. Okay, they borrowed 1,000. Okay, from by your term loan or something like that. From term loan, you would have brought equity also. You would have brought his capital also. Then he has used 1,000 for buying a machinery, fixed assets. So this is for fixed cost source. This is called fixed assets. So it has been used. So there is no surplus here. There is no surplus and no shortage here. Okay. Whatever they brought 1,000 rupees, 1,000 they have spent it here for construction, well and good. In this case, the short-term source means current liability. What is current liability? Current liability is one which can be liquidated with a period of 1 year. Okay. So this current liability already I have told in my current accounts, current assets session. The current liabilities are incurred to create current assets. Okay. So additionally, plus margin also will be used for building current assets. Okay, this is main thing. So here you got short-term uses. They said current assets. It is what is current asset? Current asset is one which can be paid within a period of 1 year. Okay, which can be encashed within a period of 1 year. So this is so 400 they brought current liabilities and they built assets for 400. There is no surplus here. This is so okay, one thing. So second company, the long-term sources 1,100, they used only 1,000. Okay, the 100 surplus, it's called liquid surplus, long-term surplus, whatever you call surplus. Okay, the long-term sources means long-term term loans or debentures plus equity, his own money also. So now he has brought it, he has spent only 1,000, 100 is in his hand. Okay, he brought out of 1,100, he has used only 1,000. So 100 is surplus here, left out. Then he availed only 350. 350 he has availed. Yeah, that means bank loan or trade credit, something he has availed. But he has built current assets, bought current assets to the value of 450. So there is 100 shortages there because he has not taken 450, it's 350. Why he has taken only 350? Because this 100 is used for year also. This 100 is used for year. Okay, the 450. That's why 350 plus 400, 450. Yes, dollars. This is one scenario. Okay. Then in this case, now you should follow me closely. In this case, 1,200 is what long-term sources. Then he used 1,350. He has brought more than he has brought 1,200 only for debentures, term loan, equity, etc. But he has spent 1,350. He spent 1,350. So there is a deficit of 150. Long-term deficit is 150. How he has made good the thing 150. Just see this here. He has current liabilities here 450. Short-term sources. Current assets is only 300. So it is the 150 here it is 150. The surplus is here. He has used it for this building. He has used it for this building machinery, etc. So short-term sources available, he has used for, instead of buying, then he has used it for machinery, fixed assets, etc. So what are let us see the implications. Let us see the implications. So let us see this. Let us say take this company. See, 1,200 he has bought. Okay, 1,350 he has spent. So 150 already deficit. So what he had done is, instead of he is bringing his money or further availing term loan, he has touched the current assets. He has touched the current assets. He, instead of building this year 450, we can say this way, instead of building 450 with current assets, no, this is which we are going to trade. He has diverted into 150. So here, though he has got a sources is 450, current liability, sources is 450, current liability sources is 450. Then he said, already 150 surplus is there. What he would have done, he would have built the current assets here. He would have brought the current, instead of buying current assets, he has put it in the machinery. So instead of buying current assets, he has put this money in machinery, building, etc., where there will be no cash flow. Immediate cash flow will not be there because it is not a current asset. Is it a fixed asset? Fixed assets will not fetch any cash within a period of 1 year. Okay, we can put this way also. So yes, you got a 450. Okay, 150 current assets, he has sold it. He got the cash. Instead of going to the bank and adjusting this year, he has put it here for buying machinery. We can put this way. I'm just explaining this. So, who is not paid? He is not paid. His liability is still outstanding. Bank liability is outstanding. Trade creditor, suppliers of raw materials is outstanding. He should be paid. He is not paid. So liquidity is affected here. Liquidity is affected because he does not have ready cash to pay to the suppliers and get the goods. Instead, he has put the money in the machinery. So that means short-term sources used for long-term use. That should not be allowed. You got the point? So this liquidity is affected because what is liquidity? The ability to generate cash to meet short-term obligations. Okay, the ability to create cash to meet short-term liabilities. He has to pay here, no. He has to pay to the bank. How bank will allow OD? Already whatever he has done is still outstanding. There is no credit in the OD account. The OD account always should be healthy. Debit, credit. Whatever sales, cash comes from sales, he has to deposit in the bank. Then he again draw it. Like that, will not be there. It will be dormant because he is not. Like that also to suppliers. He should have paid 150 to suppliers. He has not paid. Outstanding 450. Then will he supply? Will your suppliers supply goods to you? It will be a very serious condition. Liquidity is worst. Liquidity is no liquidity, worst situation, because instead of building up current assets, instead of liquidating current liabilities, he has diverted the amount in fixed assets. Long-term use. Long-term use means fixed assets, buying a fixed asset, buying a building, buying a machinery, buying a AC, all fixed assets. It is not for current assets. It is not for goods in which you are dealing. You got the point? So it's very important. So the situation is very bad. But on the other hand, you see this company, the current liability is available only 350. So which was used for building up current assets 450. So they availed sources, current liabilities to the extent of 350 only. So 450 they bought it. So there is adequate liquidity. So they can even pay the current liabilities full, and they can draw from them. They can draw from the bank once you liquidate, once you adjust it, once you credit the deposits, and avail the fresh limit. Again, you can draw it afresh, and you can go on buying goods and selling. There will be no problem from supplier side, from bank side, because there's a healthy rotation in the bank and with the suppliers. All dues are paid. So this is the ideal situation. This is a very ideal situation. And here it is a problem because there is short-term sources used for long-term use. So again, current liability is outstanding. Suppliers may refuse to supply. You may not be able to, you may not find cash to pay your power bill, EB bill, etc. There will not be any power also. And the wages you won't be able to pay because your liquidity is affected, seriously affected. Worst situation, no liquidity, you won't be able to pay wages to your workers, you won't be able to pay to EB, and you won't be able to pay for the power and raw material supplies, etc. And there will be a chaotic, very serious situation. In this case, it is a very hectic situation where the neither surplus from the long-term sources and there is no deficits or surplus in the short-term uses also. But thing is, it is very hectic situation because the 400 current assets you have to liquidate and to pay the current liabilities to 400. Here it is close. You are not sure that you will be able to fetch 400 to pay 400 current liabilities because you may supposing it consists of some book debts, they may not pay fully. There will be some bad debts. Suppose somebody pays instead of 400, supposing somebody pays 350, then you have to pay only 350, 50 is outstanding. Again, problem. So it is no liquidity here. This is also the situation is very also not good. Only this wise situation is good, and that is we should not go. There should be financial discipline that long term, short term sources should not be used for long term use. This is the thing. Let us see the consequences for diversion of funds for long term use. First thing is you see there will be supposing you are buying a machinery, buying a building, there will not be immediate cash flow. There will not be any cash flow. There will not be available any cash. Will you sell the machinery? Will you convert it into cash? Machinery is not for converting into cash. It is long-term fixed assets, long-term fixed assets, permanent assets with which you can carry on the business. Okay. Second, suppose because it is outstanding, current liability you are not paid, so your supplies you are not paid, EB you are not paid, wages you are not paid. When then what happens? Tell me what happens. Suppliers will not supply goods. Workers will not come to you for work because you are not paying the wages. Power will be cut off because you are not paying EB. See the consequences. Very dangerous situation. Very dangerous situation. Then again, bank will not go further OD. Bank will not give any extra further credit to you. They will not help you because you are not getting service interest. There are no healthy operations. Please understand this. Okay. Then again, it will paralyze the whole functioning. As I told you, that it will paralyze the whole functioning. You won't be able to carry on. Then again, you will be forced to borrow from higher rate of interest from others. Which will again kill your profits. It will kill your profits. Then again, assets which are not encumbered so far, assets which are not mortgaged so far, you will be forced to mortgage for getting additional loans. That is the worst situation. That is the worst situation. So, two things I want to tell you. Don't divert short-term sources for long-term use. First. Second, maintain liquidity by bringing some money from long-term sources like equity, etc. These two very important. This is a good lesson for you. To maintain a financial discipline, don't divert short-term money, short-term sources for long-term use. One. Second, maintain liquidity by bringing your own margin by liquid surplus from long-term sources in the system. You will have liquidity. There will be smooth going of your business. I hope you have got it from me. We'll meet in some other sessions, some other classes. Till such time, take care. God bless you. Thank you.